Good afternoon, everybody. And I'd like to welcome you to this webinar entitled FATF Greylisting, Tax and Reporting Implications, organized by Mazars in Malta. What impact will greylisting have on Product Malta? Does Product Malta need to change in order to exit from the grey list? What dilemmas does Product Malta create for MLROs? How can Product Malta be more resilient and future-proof? These are some of the issues we will attempt to touch upon in this webinar. My name is Alan Craig, and I'm a partner at Mazars, responsible for the business advisory team. I have, over the recent years, worked extensively in the field of anti-money laundering, having assisted both private entities and the competent authorities on various projects. The opinions that we express in this webinar are based on our personal opinion and do not reflect the official position of Mazars. Always ensure that you seek professional advice prior to taking any decisions or actions that may affect you or your firm. On the 25th of June, 2021, Malta, to the surprise of many, including myself, was placed under the grey list by the FATF. 3 action points were mentioned by the FATF, 2 of which make reference to tax crimes. So far, public discussion has principally centered around the strengthening of the institutions, the Commissioner for Revenue and the police. References have mainly been made to domestic tax evasion. Yesterday, in fact, the Minister of Finance stated that the government would adopt a zero-tolerance attitude to tax evasion, specifying or particularly targeting evasion of VAT. While reference to tax crime in the FATF public statement relates to all forms of tax evasion, the FATF undoubtedly are highly interested in the role that Malta plays as an international financial services center in the facilitation of cross-border tax evasion. Malta was placed on the grey list due to the lack of demonstrated effectiveness. The head of the FIU was recently quoted as saying that Malta would exit the grey list with 18 months or even less. Achieving and proving effectiveness is undoubtedly a challenging and daunting task. This responsibility, however, does not just lie with the authorities. We also need to start addressing what I call the elephant in the room, that is, Malta's role in cross-border tax evasion. Specifically, the discussion should not only focus on what the authorities should do, but on what we, as a financial service community, can do too. The overall objective of this webinar is to start placing these issues on the agenda and to initiate the discussion and create further awareness amongst the financial services community. There is little doubt that the adoption of a proactive approach by the financial services community will, and in a very strong way, strengthen Malta's effectiveness. And on this note, and without further ado, I will proceed to kickstart this webinar and briefly go through the agenda. So today's agenda is relatively simple. We're going to start off with 2 short presentations. The first presentation is going to look at FATF listing and the implications maybe from an AML, from a money laundering consideration. And the second short presentation would take into consideration or would look at the aspect or certain aspects relating to tax and fiscal matters. This will be followed by a panel discussion whereby we will place certain questions to a group of panelists. And finally, we'll open up the session for questions and answers, whereby any questions that you place, we could try to answer them, obviously time permitting. The panelists today are there's obviously myself, and I've made my introductions, but the panelists today are, the first panelist is Alicia Vella. Alicia is a senior manager within the Mazars Advisory Department, where she leads the governance, risk and control team. She is a certified anti-money laundering specialist and certified internal auditor and has considerable experience working on AML projects. Paul Giglio is a founding partner at Mazars and is also the tax partner. Paul is directly involved in various engagements, including large audits, international tax planning, tax compliance, corporate structures, as well as groups restructuring. Paul is a certified public accountant and holds a master's degree in finance. Ruth, on the other hand, is a tax director with our firm and heads the direct tax service line, leading a team of dedicated professionals, providing a wide range of tax advisory and compliance services. Ruth is a certified public accountant and holds an advanced diploma in international tax. She is a member of the Malta Institute of Accountants Direct Tax Committee. And if I can just go to the next slide, just some brief housekeeping rules. All participants are on mute for obvious reasons. We are recording this webinar, and we are recording it basically for administrative and quality control purposes. If you would like to submit a question, there is a Q&A button at the bottom of your screen. Please press that and type in any question. And as I said before, if we do have time, we'll try to answer as many of those questions as possible. Finally, CPE hours. This webinar qualifies for CPE hours. And tomorrow, all participants will be receiving an email with instructions on how they can apply for their certification on CPE hours. So that's enough from me. I'd like to start off and kick off the first presentation, which will be given by Alicia, and which will deal with AML considerations relating to FATF, greylisting.
So thank you, Alan, and good afternoon, everyone. In the next couple of minutes, we'd like to go through a number of areas relating to money laundering and the link also to tax evasion. And we cannot start this discussion off without looking at the last couple of years and looking at the Moneyval reports and also the FATF greylisting. We'll then move on to look at the definition of money laundering, predicate offences, and how tax crimes comes into the picture. We'll then move on to look at tax evasion, the manner in which it's featured within the National Risk Assessment, and also within the National AML Strategy and Action Plan. We'll then look at some numbers, look at particularly the SCRs which were raised in 2020, and see those which related to tax crimes. And last but not least, our reporting obligations. We would like to assess what's changed in our reporting obligations, and if anything changed, we'll go into these. So if I can start off with looking at what happened in the last couple of years. So we've been hearing a lot about Moneyval in recent years, but this was not something which started only recently. Moneyval reviews have started since 1998. If we had to look at the last 10 years, there was a fourth Moneyval Mutual Evaluation Report, which was carried out, which was issued in 2012, which also resulted in a number of deficiencies for Malta. And in following this, Malta was placed under the regular follow-up until December 2015. And then the fifth round mutual evaluation came about in 2018, following which a report was issued in July 2019. And during this review, Moneyval reviewed two aspects. The first one relating to the compliance aspect, and the other one to the effectiveness of our AML legislations, rules, and regulations. This resulted in a number of deficiencies, as we all know, and there were 9 areas from a technical compliance point of view which were rated as partially compliant, and there were 3 areas which were rated as having low effectiveness. This triggered the first enhanced follow-up, which analyzed the progress of Malta in addressing the technical compliance deficiencies identified in the prior report. It's good to note that during this review, Moneyval did not assess the effectiveness, the progress made by Malta when it comes to the effectiveness of the implementation of the AML CFT system. As a result of this, there were a number of basically all the areas which were partially compliant, which were 9 areas, were re-rated, and they were re-rated mostly as largely compliant, and 2 of which were also rated as fully compliant. So good news, we passed the test. However, following that, as Alan said, this is a surprise to everyone, then the FATF greylisting came along, and the FATF commented on 3 action points which Malta has to work on in order to basically get off this grey list. Two of these relate to tax evasion. The first one relates to Malta and continuing to demonstrate that beneficial ownership information is accurate and that proportionate and dissuasive sanctions are applied both to legal persons, okay, if information provided is found to be inaccurate, but also to gatekeepers when they do not comply with their obligations to obtain accurate BO information. The second action point relates to enhancing the use of FIU's financial intelligence to support authorities pursuing criminal tax and related money laundering cases, including by clarifying the roles and responsibilities of both the Commissioner of Revenue and also the FIU. And the third action point is about increasing the focus of the FIU's analysis on these types of offences to produce intelligence that helps Maltese law enforcement detect and investigate cases in line with Malta's identified money laundering risks related to tax evasion. Throughout our session today, we'll be understanding the manner in which these two action points may be implemented in practice and their effect on us as subject persons. So, as we all know, the goal of a large number of criminal acts is to generate a profit. And money laundering is the processing of those criminal proceeds to disguise their illegal origin. So for money laundering to occur, there needs to be two critical events: the criminal offense and the flow of funds or assets which was generated from that criminal offense. The actions then to clean those funds through the three-stage process that we're all very familiar with, which are basically the placement, layering, and the integration then, is what constitutes money laundering. If I had to look back, after the financial crisis, there has been greater political scrutiny aimed specifically at tax evasion and aggressive tax schemes. Various international initiatives were taken by global bodies such as the International Monetary Funds, the G20 and the United Nations, and many laws have been enacted since to curb tax evasion. We have also seen regulations regarding tax evasion and money laundering being interlinked. There are also substantial similarities between the techniques used to launder the proceeds of crime and also to commit tax crimes. The introduction of tax crimes as a criminal offense occurred in 2012 when FATF amended its recommendations and included tax evasion as one of its predicate offenses for money laundering. Following the direction of the FATF in 2015, then the fourth anti-money laundering directive included tax crimes in the broad definition of criminal activity. Subsequent to that, there was the sixth anti-money laundering directive, which harmonizes the definition of money laundering across all EU jurisdictions. And it defined two predicate offenses which are considered as criminal activity. And one of these criminal offenses is actually tax crimes. And this is defined as tax crimes relating to direct and indirect taxes as laid down in national law. If we have to look from a national perspective, Malta no longer has a restricted list of predicate offences, and since 2005 has adopted an all crimes regime, meaning that any criminal offence, whenever or wherever it is carried out, may constitute the basis for the offence of money laundering. So it is also interesting to look at the manner in which tax evasion featured within the national risk assessment. The overall money laundering risk of Malta was assessed as being medium to high, and this was the result of two major risk factors, two major risk components, which are the foreign proceeds of crime and the domestic proceeds of crime. The foreign proceeds of crime were rated as being a high risk for Malta, and these were due to crimes committed abroad and those funds being channeled through Malta to clean out those funds. The national risk assessment, however, did not define the nature of these crimes, which may also possibly include the tax evasion. On the other hand, on the left-hand side, we see the domestic proceeds of crime, which was rated as medium to high, and this was the result of a number of risk factors And the highest of these risk factors were the local criminal groups and tax evasion. Something to note about this national risk assessment. So what is the national risk assessment, which is currently in force? It's good to point out that this was an exercise which was carried out between 2013 2014, with some updating of statistics being carried out in 2017. In their report, Manival commented on the limited analysis carried out with certain risk factors. However, a revised national risk assessment is expected to be issued this year, with an action plan being issued next year, as stated in the National Anti-Money Laundering Strategy and Action Plan, covering up to 2023. So, as I said before, the National Strategy and Action Plan covering 2021 to 2023, which was issued by the NCC. Just a point to note that this was issued before Malta's greylisting. The strategy plan includes 7 overarching policy goals, and it includes also a detailed action plan for every policy. And 3 of these policies specifically make reference to tax evasions, and these are the ones that we'll be looking into today. The first one, which I already mentioned, was to have an updated to revise the risk assessment. And the goal is to improve the understanding of tax-related money laundering risks. And this will be achieved through the setting up of a committee to collect tax data and identify the risks of tax evasion. It would also include the publication of tax-related money laundering risks and typologies, and strategic analysis document of tax-related money laundering. The other policy goal number 3, relates to the coordination and information exchange between the authorities. So this includes the economic crimes units receiving intensive training, and also recruitment and tax training and investigation techniques, which specifically relate to tax evasion. The other policy goal, which is policy goal 5, relates to the detection and investigation and prosecution of money laundering, and this includes the identification of tax-related money laundering cases. And this is planned to be achieved by doing an awareness campaign, an outreach campaign, to inform tax practitioners on typologies of tax evasion and associated money laundering, as well as carrying out an exercise to detect money laundering through the use of illicit structures, such as also voluntary organization. The strategy highlights the efforts planned to be taken by the authorities to increase prosecution of money laundering cases, and the awareness and importance which is given to tax evasion as a predicate offense. Now we look at some statistics to understand the actions taken by subject persons in relation to tax evasion. If we had to look at the total number of STRs filed in 2020, these amount in total to 5,090. And this is an increase of 89% over the prior year. 31% of these tax crimes relate to the suspected predicate offense is actually, so 31% of the STRs relate to suspected predicate offense, which is actually tax crimes. However, when this is taken into consideration in the context of the type of reporting entities who filed the 5,000 STRs, we might draw different conclusions. So the next question that we would pose is then who raised these STRs? And on the right-hand side, you can see statistics of the type of reporting entities which filed these STRs. 49% of these STRs were raised by remote gaming companies, followed by 39% raised by credit institutions. And we had to focus on the STRs which were raised by gatekeepers, particularly CSPs, advocates, accountants, and auditors and tax advisors. These merely amount to 1% of the total STRs. So although one might say that 31% of those, the total STRs relate to tax crimes, however, when this is taken into context of who raised them, the probability of these being raised by gatekeepers is on the lower end. And the next slide is relating to our reporting obligation. And one might ask, what changed in our reporting obligations? The reality is that nothing changed in the obligations, and the obligations set within the IPs have been there for a number of years. And if I had to look at what the IPs state, they state that the MLRO must file an STR with the FIU when it determines that the subject person knows, suspects, or has reasonable grounds to suspect that a transaction, included attempted transactions, may be related to money laundering, or a person may have been, is, or may be connected to money laundering, or money laundering has been, is being, or may be committed or attempted. It's also good to note that subject person are also required to report attempted transactions as well that are deemed to be suspicious, but which never materialize. So it could be also instances where, for example, a client is not onboarded, so a business relationship has been formed, but if the MLRO has suspicion that, again, this client, this prospective client could be linked to money laundering, the MLRO has an obligation to report. So then the next question would be, so what changed? We have seen that the spotlight on Malta, particularly relating to tax evasion, and we've seen that Moneyval in its 2019 report commented that despite tax evasion being one of the highest risks within the National Risk Assessment, there were almost no investigations or prosecution of money laundering of tax evasions. Subsequent to the Moneyval reports, we have seen the planned national effort to increase money laundering prosecutions and also the importance given to tax evasion. On the other hand, in the previous slide, we have seen the low number of SCRs raised by gatekeepers. This despite the fact that authorities estimate that approximately 98% of legal persons seek the services of a Maltese CSP, lawyer, or accountant sometime during the life cycle of the company. In view of this, gatekeepers are expected to have more awareness on tax evasion, the typologies, risk indicators, and red flags, and not just by the MLRO, but also by the first line of defense. Whilst we are not expected to become tax experts, we are expected to report a transaction when there is suspicion of tax evasion happening, both locally and internationally. And this takes me to the end of the presentation. I'll leave it in the hands of Ruth.
Thank you, Alicia. Thank you for that interesting presentation. And I invite Ruth now to give a short presentation on tax matters and tax issues. Sharing your screen. Okay, thank you.
Thank you, Alan. Thank you, Alicia. Good afternoon to everyone. As Alan and Alicia said, my presentation will relate to on this subject with respect to tax and fiscal matters. So,
okay. Seems like we have a technical issue.
okay. Sorry about
Okay, resolve that. Okay, Ruth, can you take over? Thank you.
So the agenda for these few minutes that I will be giving this presentation are mainly these 5 points. First of all, I will look at the provisions in the Income Tax Management Act, which relate to tax evasion and the powers of the Commissioner for Revenue in respect to evasion of taxation. Then we'll look at some statistics. Thereafter, we will go through the cooperation regulations that are included in Maltese legislation. We will look at which arrangements are reportable in terms of DAX. And the very last slide will be a look to the future. What do we expect now from a tax point of view? If you had to look at the right hand of the slide in blue, over there we have the definition of tax evasion. This definition comes out from the Income Tax Act, whereby it clearly defines what tax evasion constitutes. So tax evasion includes the following: omitting income which should have been declared, making false statements in a tax return, giving false answers to requests for information requested by the Inland Revenue Department, preparing false books of accounts, or altering or destroying, concealing relevant documentation. So as we can see, the legislation clearly defines what tax evasion constitutes. If we had to look at the left-hand side of the slide, over here there are sections of the Income Tax Management Act, which highlight the powers of the Office of the Commissioner for Revenue when it relates to tax evasion. These changes, these articles have been as a result either of recent changes to previous provisions or new articles which were included in the Income Tax Management Act. The first one relates to official secrecy. Before, officials working at the Inland Revenue Department weren't able to provide information about taxpayer unless they get permission from the Prime Minister of Malta. That has been changed, that has been overruled, and now it is the Commissioner for Revenue who would give the right to an official at the Inland Revenue Department to disclose information about a taxpayer in the course of seeing a situation of tax evasion. If we had to look at Article 10A of the Income Tax Management Act, we will find that when the Inland Revenue Department requests a taxpayer to provide information about his affairs, the number of days that the taxpayer has to reply has been reduced. Before it was 30 days, and now it has been made more onerous. So now the taxpayer has to give his responses within 20 days in terms of the law. The third bullet point relates to Article 14.3 of the Income Tax Management Act. And over here, it is stated that the Inland Revenue Department has the power to request a designate person for information when there is reasonable grounds to suspect there is tax evasion. And we have a definition of what a designate person is, and this definition is quite far-reaching. Over there, we have included a lawyer, a trustee, an accountant, an auditor, banks, insurance, notaries, and legal procurators. It's a very wide definition. So these designate persons, if requested by the Inland Revenue to provide information about taxpayer, they need to give a reply within 15 days. And the law tells us that this reply should be given irrespective of obligation arising out of the GDPR, Professional Secrecy Act, or any other fiduciary obligations. And finally, the last point, it's Article 20. Article 20 gives the power to the Inland Revenue Department to have free and full access to premises of taxpayers, be it offices, be it factories, be it warehouses, be it garages, always if there is suspicion of tax evasion. Over here, the law tells us that the Inland Revenue have the right to request assistance from the police force. One should note that when this article, the slide, relates to domestic tax evasion, we have heard that the FATF are not only after domestic tax evasion, but are also interested in cross-border tax evasion. In the next slide, we will see how another matter which relates more to a cross-border issue. Now we will see over here in the slide, we have some statistics. On the left-hand side, we have a number of court cases which have come out when a search has been made on the eCourts website. Over here, we can see that in the last 5 years, the number of cases which have been heard in the front of the Court of Magistrates when it relates to tax evasion are only 11. We can see that we have 6 of them which relate to car registration tax and duty on imports. We have 2 relating to capital gains tax and stamp duty, 1 relating to VAT, 1 relating to an extradition proceedings, and 1 which relates to money laundering and tax evasion. On the other hand of the slide, we can see that a statistic which has been published in 2019 shows that up to 2016, the loss of the GDP of Malta resulting due to tax evasion is the highest. It is 2.34%. So one would question why. Why do we have such a low amount of cases when we are seen to be losing so much of GDP because of tax evasion? One should note here that the cases mentioned, the 11 cases mentioned, which are showing in the left-hand side of the slide, relate only to those which are heard, cases which were adjudicated, first of all, and which were heard in front of the Court of Magistrates. We are all aware that there are some cases which are heard in front of the Administrative Review Tribunal. These usually do not relate to tax evasion and would relate more to procedural matters. Cooperation regulations. Cooperation regulations are part of our legislation. This is a subsidiary legislation of the Income Tax Act, and it relates to exchange of information. What is exchange of information? Exchange of information is Malta's commitment to share information with other jurisdictions with the view to combat tax evasion, artificial shifting of profits, and other matters relating to tax. The slide is divided into 6, as can be seen, and these are different methods how the Inland Revenue Department can share information with other authorities. So what happens here? What is happening here? Basically, the Inland Revenue Department will have to capture information about taxpayers, either through the taxpayers themselves or else through other parties like financial institutions or intermediary. If we had to look at the first one, automatic exchange of information. Over here, the Inland Revenue Department is gathering information from the tax return of taxpayers. And for example, if we see the second bullet point, when there is in the tax return a declaration that employment income has been, a company has paid salaries to employees which are not being subject to tax in Malta, that information is automatically shared with the country of residence of that employee. This also applies to directors' fees and even ownership of a movable property. Then we have spontaneous exchange of information, and this would apply wherever the Inland Revenue Department sees that a particular transaction in Malta could result in a loss of tax in another EU member state. Okay, this over here, we're talking about artificial transfer of profits. On request, exchange of information. So over here, we could have a case where an Inland Revenue Department of another jurisdiction would be looking at the tax affairs of an individual, and this individual has business affairs in Malta. So it could be the case that a request is made to the Inland Revenue Department to provide information about this particular taxpayer. FATCA and CRS, this has been with us for a number of years now, and probably we are all familiar to it. This poses an obligation for financial institution to register with the Inland Revenue Department and provide certain information about taxpayers. When it comes to FATCA, this relates to US taxpayers, and CRS would relate to other taxpayers which are part of the OECD. Country-by-country reporting. Country-by-country reporting applies to large multinational enterprises, which usually have revenues which exceed 750 million. There is the obligation for such companies to disclose to the Inland Revenue Department data of the group, which includes profits, taxes, residence, and residence jurisdictions of members within the group. And finally, DAX 6. DAX 6, we've heard a lot about this. This poses an obligation on us intermediaries to disclose certain reportable cross-border arrangements to the IRD. And to go a bit into more detail about DAX 6, first of all, when is a Taxar arrangement classed as reportable? Now, the objective of this session is not to go into detail of what DAX 6 is and how the reporting should be done. It's more to give a brief idea of what the process entails and which arrangements are considered to be reportable. So first of all, there has to be a cross-border arrangement. So it is an arrangement that involves either more than one EU member state or otherwise a EU member state and a third country registered outside the EU. Secondly, there should be a hallmark. What is this hallmark? This hallmark is an indicator that the arrangement is considered as aggressive. Okay, we will see in the next slide what these hallmarks are. Another important point is the main benefit test. The main benefit test is met if one of the main benefits of the arrangement is that the user is gaining a tax advantage. If we have all these together, then it results that this arrangement should be reportable to the Inland Revenue Department. If we had to look a bit into more detail at the hallmarks, first of all, the main benefits test. The main benefits test over here, the law obliges us to do a comparative analysis, and this is the value of the tax advantage out of the arrangements over other benefits. Okay, so the tax advantage should not be merely incidental, but additional steps should have been done to obtain this particular advantage. And before I mentioned hallmarks, these hallmarks are divided into 5. And over here, we're seeing that these are called generic hallmarks related to the main benefits test, some specific hallmarks relating to this test, certain cross-border transactions, automatic exchange of information and beneficial ownership, and the last one relating to transfer pricing. As I said before, the scope is not to go into detail into all these hallmarks, but I will go explain one of each out of each section to give you an idea of what these hallmarks are. First of all, under the generic section, one of the hallmarks is the receipt of a fee contingent to a tax advantage. What is this? If an intermediary is receiving a fee which is contingent to the tax advantage that the taxpayer is making out of an arrangement, then that arrangement is considered to be aggressive and should be disclosed to the Inland Revenue. The second one, the specific hallmarks relating to the main benefits test relate to circular transactions involving interposed entities without commercial function. So over here, we could have a structure where there are multiple entities involved. It is not clear what the commercial function of these entities are involved, and funds are being passed from one entity to another without having proper economic sense. Over there, that is also considered to be an arrangement which has to be disclosed to the Inland Revenue under DAC 6. Cross-border transactions. Under cross-border transactions, one should note that certain deductible cross-border payments would need to be disclosed to the Inland Revenue. And when is that? Where at least one party is either without residence, so you could have an entity where it's not clear where this entity is resident, or else resident in a jurisdiction listed as either non-cooperative or as preferential tax regime. Over here, one should note that the guidelines published by the Inland Revenue includes links with lists of which jurisdictions are listed as non-cooperative or preferential. Automatic exchange of information and beneficial ownership. When an arrangement includes, and it is under an arrangement, it is not possible to identify beneficial ownership, then that could constitute an arrangement which has to be disclosed. Over here, one could possibly include arrangements with jurisdiction where there isn't the obligation to disclose the beneficial ownership to the registry. Okay, and finally, transfer pricing. Transfer pricing, we all heard about transfer pricing, and the DAC 6 also includes a hallmark which relates to this topic. And over here we are told that if there is a transfer of intangible assets which have high values or values which cannot be easily determined, and that constitute a reportable arrangement. And finally, my very last final slide, where do we go from here? You may have heard of Beps. Beps has been with us since 2016. As you probably know, Beps means base erosion, profit shifting, and it is an attempt by the OECD and G20 to combat artificial transfer of profits. Over the years, we have already seen changes to our laws as a result of Beps, and these include CFC legislation, interest limitation rules, and other provisions. And now we have these final two changes, what is being referred to as Pillar 1 and Pillar 2. Pillar 1 applies to very large companies. We are talking about companies which have a global turnover of 20 billion. So we're looking at big companies like the Amazon, the Apple, and companies of a similar size. Okay, over here, in the Pillar 1, basically, these companies have to abide with this regulation, whereby tax has to be paid where the profits are actually generated, and that is Pillar 1. Pillar 2, on the other hand, relates to companies which have a global turnover of 750 million. And this Pillar 2 attempts to set a minimum tax floor of 15% for these companies. And globally, these companies should pay tax amounting to at least 15%. That is all I have to say from my side, and I leave it in the hands of Alan.
Thank you, Ruth. Thank you for that presentation. And I think Ruth's presentation sort of brings us to the next phase of this this webinar that we have. And in this phase, sort of we want to sort of create a panel discussion and start talking about, start asking questions, the panelists questions, about topical issues, about issues that we all feel, that we're all asking and we're all talking about. So Paul, can I start with you, please? As clearly came out in the presentations, both tax evasion and lack of enforcement are very much and have been very much the concern of FATF. In Ruth's slide over here, especially the last one, under DAC 6, we're seeing efforts both at an international level, at the global level, OECD and G20 level, to reduce the effectiveness of financial services centers such as Malta. Is our greylisting another attempt to reduce this effectiveness? Is it the last nail or one of the final nails in the coffins of our tax refund system?
Thank you, Alan. That's quite a question. And if I had to answer that question, I think I'd need to go back to the slides of the three of you, the three presenters before me. All of you mentioned something, Alan. You started by saying that FATF is mainly targeting international tax evasion, and that's true. Alicia spoke about what international bodies are doing in this part, and Ruth gave us the definition of the local definition of tax evasion, and she also went into the future. But if we now had to keep those things in mind and had to look at our laws, we'd realize, and had to also read the FATF conclusions, we'd realize FATF never mentioned the 6/7 refund when they came to the greylisting. At least to my knowledge, it was never there. FATF is aiming at, not at seeing what there is in Article 48 of the Income Tax Act, which brings about the tax refund, or our imputation refund, which has been there since when the Inland Revenue, the Income Tax Act was designed in the 40s. No, FATF is targeting the abuse, and not the use, not the correct use of our products. And this is why when I hear this question, the 6/7 refund, this is indeed the elephant in the room, because I've been in this sector for a number of years, and it always comes up: is this the end of it or not? No, I believe that at least this is what I believe, that FATF here in its conclusion is targeting the evasion. So it's targeting the improper use of our structures. It's targeting a structure maybe where there is absolutely no substance. And to make it even worse, to make it even more profound, this structure is obtaining a tax refund. Maybe a structure which is used for laundering of money, maybe a structure which is used for criminal activities. Those clearly are being structured, are being targeted, because those particular structures, when there is tax refund, it is generating a tax refund to a person who has used a structure for criminal intent. And that is what we must pay attention of, not the 6/7 refund. Not the 6/7. It is its improper use. That is where I think we should focus on.
Okay, so it's not the rules or the fiscal setup that is included in Product Malta and our offering. Paul, if I can understand you well, that is the issue, but it is the way that these are used. I would assume that being an international financial services center, there's sort of a bit of a pull power for entities, businesses, persons to be attracted to this attractiveness and to maybe sort of the concentration or the risk of having such structures or possibly illicit use increases. And in my view, there's nothing wrong in having higher risks. The issue about having higher risks is the controls, the effectiveness of those controls that you have in place. And I think this is possibly one of the or the concern and the issue that we have with FATF. And as gatekeepers, and here I'm talking about the DNFBPs, we are very much part of the first line of defense of this national control structure that we have in keeping out these bad apples, these rotten apples. Alicia, if I can ask you, are there any red flags that are typically associated with tax evasion, that MLROs, teams that are onboarding, people who are involved in the monitoring of transactions for the purpose of money laundering should be aware of, should pay particular attention to?
I think, Alan, before actually going into the red flags, I think we need to understand the manner in which Malta can be used to launder monies derived from tax evasion. As we all know, there are those three stages of money laundering: the placement, the layering, and the integration. If I had to look, for example, at the placement stage, a structure in Malta can be the prime source used to evade tax in another jurisdiction. If we had then to look at the layering, the company in Malta could be a part of a wider complex group structure, which may or may not involve higher jurisdictions, which would have been set up specifically to create a web of transactions, to make it more complex and to obscure the source of funds, which in the case of tax evasion would be those profits which should have been taxed elsewhere. If we had then to look at the last stage, the integration, a company in Malta could be used in order to clean monies through our tax refund system, as Paul has just mentioned, that is bringing illicit monies to Malta and EU jurisdiction, and showing that the latest source of funds was, a tax refund issued by the government of Malta. With respect to the question with respect to the red flags, yes, there are a number of red flags which can, help us identify higher risk areas relating to tax evasion. However, these red flags are not uncommon to other typologies. And these can be red flags, for example, relating to the company structure, relating to particular suspicious transactions, or also to customer behavior. So we had to look at a couple of examples. For example, relating to the customer structure, you could have, an uncommon and overly complex group structure without having a clear and legitimate commercial purpose. You can have structures specifically designed to conceal certain information, particularly information about the beneficial ownership. You can have, for example, the use of nominees, again, without having a legitimate commercial purpose. You can have a complex group structure without having professional advice to support that group structure. Use of shell companies, or the lack of economic purpose and substance, and when the overriding purpose of this structure in Malta is to avoid paying tax elsewhere. We can then look at some red flags relating to suspicious transactions. You can have withdrawals, for example, by a legal representative of the company, again, without apparent business reason, frequent and substantial monies flowing into and out of the company to high-risk jurisdictions without commercial purpose, excessive withdrawals, under or overvaluing invoices, and also excessive debt assignments and shareholders' loans, again, without adequate justifications. You can then have instances, where the customer is super secretive, he has or she has restrictive communication channels, he has expressed concerns on the amount of information which the subject person can report to the authorities. I just want, however, to make it clear that while having one red flag doesn't mean there is tax evasion, subject person, there should be more awareness by the MLRO, designated employee, and the first line of defense of the risk, to understand the risks, the inherent risks relating to tax evasion of its customer profile, being on the alert. And as soon as they notice a red flag, or possibly, multiple red flags, stop and understand the situation. When red flags arise, a subject person should consider, whether it is appropriate to, ask further information without the risk of tipping off the client. And a simple response, for example, of tax planning is not sufficient. It shouldn't be sufficient to provide, an explanation on its own. So just to close off and to emphasize that one red flag may not necessarily give rise to or elevate the risk of tax evasion, and in case that we have a legitimate explanation for that red flag, there may be no risk of money laundering and tax evasion.
Okay, thank you. Paul, if I get to put you on the spot again, maybe. We talk about tax evasion, we talk about tax avoidance. In practice, the distinction and difference between tax evasion and tax avoidance is not clear at all. And especially when we put that into an international context, and especially when I know that there are a lot of different opinions, and it is very subjective. So even just steering away and moving away from that for a second, in the light of our jurisdiction, are there any, in your opinion, typologies, tax structures that maybe in today's reality, in today's light, are maybe overly aggressive, not necessarily illegal, but maybe overly aggressive? Paul.
Yes, Alan. It's a very valid question. Let's start off by saying again that different financial centers in the world all have their fair share of aggressive structures. Alicia mentioned, when I was listening to Alicia mention the red flags, there are various financial centers in the world which tick a lot of those boxes. I'm not saying them on a grey list, but there are a few which still use bearer shares, for example. Anyway, so to come to your point, because the question over here is what with those local typologies or those local structures. I think that historically, over the past 10, 15 years, we as Malta, as Product Malta, we as service providers should have, or have in actual fact, started to go through the way we're selling our products and start to sell them in a manner which is more in line with today's world. By more in line with today's world, I mean that we have structures which have both economic substance and both have physical substance. In other words, we start to think of employees, start to think of bank accounts, start to think of Maltese laws governing contracts, not some international, not some foreign law governing a contract. We start to talk of transfer pricing. We start to ensure that the value of a particular service which is being provided by a Maltese company is reflective in the price, and is not the price is excessive when it comes to the value. And this is how we start to change to ensure that the structures which we have are not overly aggressive. I think as time went by, we even start to recommend that foreign companies have got their separate offices rather than an office within an office, and all these things started to help to ensure that Maltese structures are less aggressive. To note that even as a state, an attempt has been done to even try to make maybe Product Malta apparently, or not apparently, less aggressive. In fact, when we changed certain products which we had, the yacht leasing, for example, it was changed recently to make it appear to be less aggressive. If not appear to effectively be less aggressive. When we introduced the local participation exemption, again, that was another attempt. Notional interest deductions. Again, notional interest deductions are based on Italian, Belgian laws. So even there, the structures which we have over there in today's Malta are all an attempt to make them less aggressive. What I would again recommend and emphasize is the importance of having appropriate tax and economic substance in the structures which we have. And there's no definition of substance. Everybody talks about it, but there's no clear definition. What is the necessary substance, for example, for a company holding a brand is not the same as for a company holding a portfolio of investments. It differs. And everybody over there, when we are advising, we are giving our recommendations, should keep those things in mind, should look at case law, should keep those things in mind. And those are the things which I think we should keep in mind to ensure that the structures we have and the structures we have get us quickly off the grey list.
Okay, thank you, Paul, for that. Alicia, if I can ping pong to you, and Ruth, I'll take a question with you after this. Ruth, sorry, Alicia, I'm getting confused. PMLFTR obliges subject persons to raise an STR when there is knowledge, suspicion, or reasonable grounds to suspect, and that includes even an attempt, as you clearly said in your presentation. And obviously, this is where a transaction is connected or could be connected to ML, money laundering or funding of terrorism. Ruth, in your presentation, you also touched upon Tax 6, and now the new obligation that arises where there's an aggressive tax structure, and you listed the hallmarks and conditions where that could arise, need to be reported to the IRD. And Tax 6 also specifically refers to cross-border tax arrangements that are in place. Alicia, you also said that there are no changes in the reporting obligations of subject persons. There has been no update or change to the PMLFTR. Yet there is an intrinsic implication that the NFPPs need to raise more STRs in relation to suspicion of tax crime. Are there any new issues or considerations that subject persons should take into consideration? Are subject persons now expected to raise an STR and SAR every time there is an aggressive tax structure? To you, Alicia.
So we started off this session today by looking at the definition of money laundering. And we stated that for money laundering to occur, there needs to be a predicate offense, which then generated the proceeds of crime, which would be whatever cash, monies, or assets. And in the case of tax evasion, there needs to be obviously suspicion that the predicate offense is tax evasion. Thus, whenever there is the suspicion that those monies were generated from a predicate offense, our subject of the day is tax evasion, subject persons have the obligation to report even if the geographical location of the predicate offense is not known. Ruth in her slide then explained what is the definition of tax evasion according to the local laws. We've seen that criminal activities, although were further clarified in the 6th Anti-Money Laundering Directive. However, they do not define what is deemed to be a tax crime, and it leaves it up to the individual member states to define these tax crimes. So whilst we've seen the definition in Malta, however, we haven't seen, what is defined as tax crimes in other EU jurisdictions, and thus there may be a lack of consistency in the definition of tax evasion. And in fact, this was something which was also noted and stated by the EBA, European Banking Authority, which has observed significant divergences across the EU in terms of what practices are considered to be tax crimes under national laws. So the dilemmas that all MLROs face is to determine what is deemed to be tax avoidance against what is actually deemed tax evasion. So especially when it comes to cross-border transaction, which obviously are more complex and could result in this distinction between tax avoidance and tax evasion being unclear and being, we're going into these gray areas. Unfortunately, we do not have the answers and solutions. However, I refer back to the red flags that we've seen before, and the presence of multiple red flags can assist the MLRO in determining whether there is suspicion and thus whether there is an obligation to file that SCR or SAR. So basically, the next step, I think, in the light of this uncertainty and clarity, subject persons need to have a bit of more clarity on these gray areas that I've just mentioned. And this could be through guidance, which is provided by competent authorities, which, to be fair, was already contemplated in the AML strategy plan, that, typologies will be issued. There will be an outreach program to subject persons. And also, I think it's important to mention the importance of the role of the representative bodies, to act as a bridge, between the professional community and the competent authority, so that we will have one common approach when looking into these matters.
Thank you, Alicia. I couldn't agree with you more. I think this is a dilemma that we all face, and this is an area where we as subject persons need to have a common approach, and also important direction from the authorities or representatives of particular industries. Ruth, your turn. Ruth, greylisting will imply a continued heightened and rigorous regulatory environment. The amount of checks that are happening, the amount of fines and the level of fines that are being issued. And we also saw this in action point 1 that FATF said that they would like to see an increase in fine and increase in deterrent against gatekeepers and entities that report incorrect information. It's inevitable that we will continue to see this focus from the authorities on beneficial ownership and tax measures. The latter, and here I'm referring to tax measures, is probably quite technical and not within the comfort zone of many persons and many MLROs or persons working in the line of anti-money laundering. As a person who works in tax, Ruth, and has been working in tax for a considerable number of time, what advice would you give to MLROs and persons working and frontline staff?
Thank you, Alan. So first of all, like any other money laundering risk, tax evasion risk, first of all, can be mitigated through an effective application of customer due diligence, which is risk-based. So by effectively implementing any anti-money laundering obligations, subject persons are also mitigating their risks with respect to tax crimes. So it's definitely more than ever, it has always been so, but now even more, it is expected that subject persons have robust internal due diligence procedures, both when monitoring existing clients, but also on onboarding new clients. They should have sufficient internal resources, and this is not an easy one. especially for the smaller practitioners. You need to have the right people to do the monitoring of clients, as well as systems to be able to capture the information required during this assessment. Complex structures should be studied thoroughly to ensure that the beneficial owner of the structure is clear and properly documented. Another important point is to understand the commercial nature of a transaction, because if one sees that there are continuous payments which are not making sense in light of the business of this client, then one should start raising questions and trying to understand why these transactions are being placed. This could be a risk. An obvious one is training. We always say it, but it's important. It's important that we are trained, we are aware of what is happening around us, both from an anti-money laundering area as well as from a fiscal area. It is not possible for all the subject persons to be tax experts, but it is important that there is an awareness of what's going on and understand what's happening in the tax fields. One should obviously keep abreast with guidelines and new laws that are issued by the authorities. Another point which I believe will be a challenge for subject persons is probably we will have more visits from the authorities, be it MFSA, be it the FIU, and this is especially applicable for subject persons who are licensed. The FATF has criticized Malta that not enough is being made by subject persons, so one would expect that the authorities will enhance their fight against this by looking at the files of subject persons even more. With respect to people who are practicing directly in the tax field, we now would expect that we will have more questions by the Inland Revenue authorities on taxpayers. So we as tax practitioners will be asked to guide our clients when presenting information to the Inland Revenue Department. So one should start thinking of allocating sufficient resources to be able to meet the demands of our clients.
Thank you, Ruth. If we had to move on and go to another topic or to another issue that I think greylisting sort of brings about, is that traditionally a lot of subject persons have focused a lot of their efforts on gatekeeping controls. So a lot of efforts have been placed on the onboarding of the clients and trying to keep out certain clients or putting certain controls on who you accept on the customer acceptance controls. There is an obligation, and I'm sure many subject persons have adhered that, to review their clients on a periodic basis. But there is another reality. There are legacy clients that we probably all have that are sitting within our client portfolio, which in today's light might pose a higher risk than we expect. Alicia, and I'd like to address this question to you. Should our greylisting now, should we take this as an opportunity? Should it be a wake-up call for subject persons maybe to recalibrate their risk appetite and also potentially look at or recalibrate their client service offering too?
Yes, Alan, I think it's an opportunity which subject persons should take. What has been acceptable 10 years ago may not necessarily be acceptable today. Times have changed, new risks have evolved, and new crimes emerged. The issue of legacy clients exists in all firms operating in Malta. And I think what we need to ask is, are we still comfortable today in servicing these clients and offering the certain type of services to these clients. And this question, I think, should trigger a structured discussion or exercise to clearly define what is our risk appetite. That is, the amount of financial risk that we are willing to accept and to have on board as part of our client portfolio. It should be something which should be driven, so this exercise should be something which should be driven from, the highest level of a firm, so be it senior management, board of directors, partner. There should be, a clear owner who facilitates the discussion, and obviously it's also important to include in this discussion the MLRO, who can advise on the money laundering risks involved. And all members, so all members in these discussions need to understand the importance of carrying out this exercise. This is not just to mitigate the risk of money laundering that the company will be exposed to, but the financial and reputational risks involved. And when it comes to the revision of the risk appetite and then the steps which follow, I would split it into phases. The first one is, as I said, the discussion, so review the desired level of risk exposure to financial crime and identify those risks which are no longer acceptable by the company or for which the company has now lower risk exposure. And this could be, for example, certain risk scenarios, certain typologies, certain industries, geographical risks, service offerings, or a combination of all these. And the next step then, once it has defined, its risk appetite, has revised its risk appetite, the company could then be in a position to assess and determine its money laundering risk that it is exposed to based on its current customer portfolio. And this might lead, to certain, to the risk-based approach being applied. There could be, certain questions, additional documentation, which should be requested from certain customers. And however, there could still, after the mitigating controls, which basically is the ongoing monitoring, have been put in place, there would be a number of clients which would still fall outside the risk appetite. And in this case, the risking is inevitable. So the risking can be carried out either, for entire category of customers, which we've seen happening in the last couple of years in the banking industry, or on a case by case basis. The risking obviously has its pitfalls. It will result in a loss of clients, which will ultimately impact the bottom line. We will be faced with an economic dilemma, that is losing a client, in a time when, the revenue cannot be replaced. However, we should not lose sight of the long-term effect that this will have, not just our entity, but also in the national interest.
Thank you. Paul, I don't know if you have any take on this, Paul, based on your experience, the issue or the need to have an in-depth look at what you are doing, who your clients are, those legacy issues, and maybe looking at it from a firm level, but also looking at sort of any pitfalls or any risks that there could be on a national level. What is your take on this, Paul?
Well, let me just say something. As I was listening to Alicia speak, and I'm going to come to your question, and I'm not going to not answer your question. I'm going to come to it. The day when Malta was greylisted, I remember that evening, together with one of my managers, I had to go to dinner with a client from the UK, who was a trustee, and you can imagine how enthusiastic I was going to dinner, knowing what the conversation of the dinner is going to be. But he immediately started the evening by saying, "Listen, Paul, you told me in the Isle of Man, I believe we've been through this 20 years ago. And what we did as a firm, as a trustee, when this thing happened, is together with my partners, I spent 6 months in the boardroom, gone through all our clients, and doing the de-risking exercise which Alicia was mentioning. And we went through each and every client, and we said, listen, it's true it's going to cost us revenue, but in the long run, we're going to be better off. And that was because we all have legacy clients. we all have legacy clients, which we do need to do that exercise too, which Alicia mentioned, and with this, which this guy mentioned. What is important, however, and I say this on two stages, on two or three points. Number one, a client which is not good for us should not be good for another firm. Okay, there may be other firms who have a risk profile which differs from ours, maybe a bit less, but if we want to get off this grey list, sooner rather than later, this de-risking exercise which will result in clients leaving the island, not clients shifting from one service provider to the other. And one way of trying to do that, in my opinion, is that when one resigns from a client, if this client tries to move to another service provider, in the audit profession, we have a system of professional clearance, which we only have in the audit profession. So I think some possible method to try to ensure that clients leaving firm A don't go to firm B is a request for clearance by firm B to firm A. That is one point I'd like to mention in the de-risking exercise. A second point I'd like to mention is that on onboarding stage, sometimes you identify a structure and you say, this is not going to pass. This is not going to pass, and it shouldn't pass for anyone. But notwithstanding that, somehow, the structure it takes place by someone else. So what I think could be, recently, Alan, we were involved in one, you and I, where basically the due diligence process was taking long. We weren't happy with what we were seeing. We kept on asking questions. All of a sudden, we got a very cold email telling us, thank you very much, but I've moved elsewhere. And we realized that the companies were stuck here. So my point over here is this. I think there should also be an obligation on service providers to ask incoming clients whether they have already approached another local firm. Although somebody may lie and say, no, I haven't. That is going to put an extra burden on this particular client, potential client, to say the truth and to decide whether or not you will then decide whether or not this person has already addressed another firm, whether you want to take on board. It is only in this way that we as service providers can start to go through our client base, go to the de-risking process, which Alicia said, and clear that up. From a national point of view, because there's also a national point of view, I would like some more guidance. I would like some more assistance. I would like some more clarity, if possible, on what, even from the institutions, on what they are looking out for or saying. Ruth mentioned some points. We should have more visits. We should have more of these. Yes, there should be maybe more courses, more ideas, more talks, more debate like this, but not only like this, and more to help us as service providers, help us from a national point of view and the national interest to get off the grey list as soon as possible. I think that is what I would say, Alan. I don't know if there's anything else which I would add on to your question.
Thank you, Paul. I would agree with you, Paul. There is a need for us to work together as a country, not individually as firms. And I think there's a need for guidance, the authorities, the institutions, the representative bodies to give directions so that we could have a common approach. Conscious of time, it's 20 past 3. I would like to bring this webinar to a close at 12:30, and I'd just like to also leave some time to answer some questions that we have received. So I'll come to my last question, Ruth, and I'll address this to you. Maybe I'll refer maybe to your last slide that you had in your presentation. So Beps, Tax 6, FATF, greylisting, minimum tax rate. What's next? Where do we go from here? What advice could you, Ruth, give to subject persons or the NFBPs on behalf of their clients to ensure that their structures are more resilient and future-proof?
I think my first comment would over here would be that it is very easy for all of us to be alarmist and think with all what's happening around us, is there a future for this industry? But however, we need to keep in mind that legitimate tax planning is not tax evasion and is not a criminal offense. If we had to look back at what Alicia said in the first part of her presentation, the FATF has mentioned tax evasion. And so the FATF are expecting Maltese authorities to increase their intelligence to capture tax evasion and not legal tax planning. So every taxpayer has the right to structure his arrangements in a way to, as much as possible, minimize his tax incidents. The problem obviously lies, and this was referred to previously by the other panelists, that it is not clear when there is aggressive tax planning. Should we accept that? The answer is definitely no. Yes, we should try to structure arrangements in a way to reduce our tax liability, but there is definitely no room for tax planning which is aggressive. We've mentioned before, the Income Tax Act includes provisions which relate to anti-tax avoidance. So there are certain instances where the Commissioner for Revenue can overlook a certain arrangement if it is deemed that that is aggressive tax planning. We have also seen that EU rules have obliged us to include certain provisions in our laws to target arrangements which are tax aggressive, be it DAC 6, be it CFC rules, be it interest limitation rules. So to come to your question, what should we suggest to our clients to arm their structures for the future? Obviously, it's not easy to look at the future, but the suggestion that we usually give is set up structures which make economic sense. Don't let as much as possible tax to be the driving motivator to choose Malta as a jurisdiction. Tax should come as a consequence, but should not be the primary motivator to set up base in Malta. We need to definitely recognize that there is a move, especially by the larger countries, mainly through the OECD, to tax profits where value is created. So having a structure in Malta which does not have sufficient economic substance has no future over here. So as you know, the Maltese structure provide the possibility in certain instances to obtain a tax refund and minimize the tax incidence. It would be fine. It could be fine to set up the structure, but what sense would that structure have if those profits are then taxed in another jurisdiction? So as I said before, have economic substance. Now, obviously, it's not one size fits all, and service providers would have to understand the business arrangement, the line of business of our clients, and make sure that sufficient assets are placed in Malta to make the profits being generated in Malta making sense. Because otherwise, having huge profits in Malta without having assets in Malta, or without showing that the risks are being really taken in Malta, would lead to a structure which probably would have no future.
Thank you, Ruth. Ruth, I don't know, bringing this to a close, were there any final comments, thoughts that you would like to that you'd like to share with us? And maybe after that, Alicia and Paul, you could share those, and then we could maybe select a couple of questions from the various questions that have been asked and try to answer those before we draw to a close.
Yes, of course. To follow up on my last comment, I believe there is a call for all the tax practitioners to guide their clients not to abuse of our tax laws. As I said before, legitimate tax planning is still there and is not being attacked. So it is fine for clients to set up arrangements in a way to minimize their taxes, but let's not abuse of our laws, as otherwise it will be difficult for us to get off the grey lists. We should definitely guide our clients to be more responsible when structuring their business affairs. Paul mentioned some of these. We have a number of attractive fiscal provisions, be it the refund system, but not only. We have the participation exemption, we have the notional interest deductions, and a number of other provisions. These still can be used. These are not being attacked by the FATF. These were not the reasons why we were greylisted. It is their incorrect use of these provisions which has got us where we are. So let's all unite together and, as much as possible, promote a situation where our clients are responsible and structure their business affairs in a way that make economic sense.
Thank you. Alicia?
So yes, I mean, as a country, as we've said before, we need to show that we are effective in the fight against financial crime. We've already discussed, that investigation and prosecution, particularly on those cases relating to tax evasion, are expected to increase. Gatekeepers are an important component within financial services, and there is an expectation for us to raise more STRs. This would require the MLRO to be, more familiar, to be aware, understand the risks of tax evasion inherent, to the type of service that they offer into their customer portfolio. These risk factors should also be taken into consideration when doing, for example, customer risk assessments. And other than that, nothing really changed in our obligation. So we are all very familiar with our obligation to carry out, CDD, ongoing monitoring, and applying the risk-based approach. We should now continue strengthening our internal AML control framework, calibrating our risk appetites, increasing awareness within the entity, and most importantly, also reporting. We are doing this not just for our entity, but for the common good and for the long-term sustainability of our financial services sector.
Thank you, Alicia. Paul?
Yes, Alan, I mean, it's difficult to add anything to what already Ruth and Alicia have said, except maybe I would like to again emphasize on awareness. Yes, let us all be aware of the risks which we as service providers could take when we got the wrong client. Let us be aware of that because it's there. And maybe if I may, something which I always live by in my line of work, which was the last statement, which I as a student, I remember as a university student, my auditing lecturer had told us, Al, because we're in the same course many years ago, and it was when something doesn't look right, it probably is not. And that's what I like to keep in mind. If a structure comes to mind and it somehow doesn't look right, it probably is not, so it's best to avoid. And that's something which I like to keep in mind when I'm advising and working. That's it from my end. Nothing more to add.
Thank you, Paul. Thank you, Alicia. Thank you, Ruth. I'm just going to quickly take maybe a couple of questions, and I'll just ask them out, and maybe one of you can jump on that. Quick one. Since Malta is now a grey-listed jurisdiction, would EDD be required for Maltese citizens? The answer to that is no. The FIU had issued an interpretive note when we were grey-listed, and there is no requirement to apply EDD measures on Maltese customers. There's a question on DAX 6. DAX 6 requirement to DAX 6 requirement to report cross-border transactions. Can you elaborate on the reporting requirements, particularly for banks that potentially monitor and process such payments if such a scenario is identified for one of its clients? What actions should it take? Ruth, Paul?
Yes, shall I take it? So basically, the rules relating to DAX 6 have been supplemented by the Inland Revenue Department through guidelines on which, when they were issued, were very welcomed because they gave more guidance on who should report, when should report, and what is the mechanism to report. Basically, over there in the guidelines, there are definitions of intermediaries, which include banks. However, not all banks are intermediaries in terms of the law. The intermediaries should be one, be it a bank, be it an accountant, be it a tax advisor, one which is aiding an arrangement to be set up. So first of all, one should look at the role that the bank is playing in a particular transaction and see whether the definition of intermediary is defined, the definition of intermediary is met. If the definition of the intermediary is met, then the bank would have to register with the Inland Revenue Department by obtaining a specific number Okay, once this number is issued, then there is a reporting online mechanism where one would need to report certain details about the arrangement, which would include the details about the parties involved, the amount of the transaction, what is the transaction related to, which hallmarks are being met, and a number of other points. So just what I want to emphasize, just because a bank or an accountant is listed as a possible intermediary, it does not mean that all banks or all accountants have the obligation to report. It is the role that the bank is playing in that arrangement, which will determine whether it is an intermediary and has the obligation to report or not.
Thank you. I'll just take two other questions. Second question that I'm seeing. In relation to the discussion regarding 673 fund, is any of this reportable? A subsidiary incorporated abroad and having its holding company in Malta and thus receiving dividend, thus refunds will be given upon dividends. I don't know if all of you would like to take that.
Well, a subsidiary incorporating, I think if I understood the question correctly, the subsidiary was incorporated in Malta or outside of Malta. I'm not sure if I got that right, but if it's outside of Malta, then clearly over there we're probably talking about participation exemption, not about a refund. So I'm not sure if I got the question right, Alan. Over there, participation exemption. No, again, the proper use of any tax structure, whatever it is, that's the proper use of any tax incentive within a proper structure. No, it's not a reportable offense. It is the illegal use, it is the aggressive use, it is evasion, which would be a reportable offense, not the proper use of a structure.
Okay, and if I can just pick another final question, Alicia. There's a question, is it appropriate to include tax considerations as another risk factor in our BRAs and also CRAs, business risk assessment, customer risk assessment?
Yes, in fact, I think this has already been mentioned. I think some of these red flags should be included within within the customer risk assessment. So looking, for example, at complex structures, looking at the type of complex structures, structures designed specifically, to conceal BO. These risk factors should all make it to the customer risk assessment, because they ultimately need to affect the customer risk rating. Obviously, applying the risk-based approach, the higher the risk, the higher the monitoring. So they definitely need to make it to the customer risk assessment.
Thank you. And I'm just looking at time, and we're running 4 minutes over, and I'd like to bring this webinar to a close. And in doing that, I would really like to thank all of you. And we've had a really good turnout today, which actually reflects the level of interest that there is in this subject. I would like to remind all those who require a certificate of participation for CPE hours that tomorrow they will be receiving an email with instructions on how to do this. Just my concluding thoughts, and I will only take a minute here, are that this subject, what we are talking about, needs to be continued to be placed on the agenda. In the webinar, we started to scratch the surface of these issues. Draconian measures are not what we are looking for or what should be called for. To this effect, I'm aware that there are discussions that are undergoing, and I understand that these will be increasing between the authorities, the competent authorities, the NCC, and representatives of the industry bodies. Our part out of the grey list is dependent on all stakeholders. Whilst the small size of our island brings certain disadvantages, on the other hand, there are attributes that we can leverage to our benefit. Size, familiarity, resilience, responsiveness, all come to my mind. Together, we stand strong. The authorities, with and through our representative bodies, need to set the direction. It is then all our responsibility to play our part and make a difference. Thank you, and I wish you a pleasant afternoon.
Thank you very much.